Okay, now let's talk about risk premiums. Previously, I have introduced you the interest rate or the T-bill rate, which is guaranteed by the U.S. government. We call it risk-free because the U.S. government never failed to pay the money back. So let's say if you have 2% for the T-bill rate, so that's issued by U.S. government, and you know for sure you will get 2% regardless of the economic condition. If you want to invest your money in other individuals or in other businesses, you should require a return that is higher than 2%, higher than the risk-free rate. Okay, it's because other individuals and other businesses have certain risk involved. And you could either require 5% if it's a small amount of risk or require 25% if it is a large amount of risk. So the risk premium basically is the required return minus risk-free rate of 2%. So for one business with 5% return, the risk premium is 3%, which is 5 minus 2. If you require 25%, then the risk premium is 23, which is 25 minus 2. So right here, you will see a different kind of corporate bonds. So this is the data of 2013. At that time, the U.S. Treasury bonds on average gave a return of 3.18%. And this is a benchmark. This is the basis that you require the other business to pay you upon. So right here, the U.S. the risk-free rate is 3.18. So any investment, any other bonds other than U.S. Treasury bonds should give you a return that is above 3.18. So if you look at corporate bonds, these are the bonds issued by companies. Well, you know, companies sometimes get bankrupt, so that's a certain risk. If this is a high-quality company, like a AAA or a AA, then the interest rate is 3.94%. The difference between this 3.94 and 3.18 is the company's risk premium. And you can see that for all the corporate bonds, once they have certain risk involved, their returns are higher than the T-bill return, the risk-free return. So the lower quality of the company, then the higher required return you should have, right? It's because for these lower qualities, like a medium quality or speculative quality, then they have a higher level of a default risk. Okay, that means you are more likely of not getting your money back. So investors would require higher return here. And again, the difference between the return of these assets of these companies and the risk-free rate is called risk premium. This is how they calculate it. It's just a simple subtraction. So here are some other risk premium components. The primary one is the default risk. The default basically means you break the contract. Once you borrow money, you are making, once the company borrows money, the company is making a contract with the investors. So if the companies cannot pay back investors the interest and the principal, then they default. Okay, so that's the case. The company that usually is a bankrupt, right? So when the company does not make enough money but have a lot of expenses, so they just file bankruptcy. They can't pay back the debt, so that's called a default. So that's the only case when a debt investor cannot get their money back. So that's the most fundamental factor, the risk factor, to determine the bond interest rate. And also you have this maturity risk. Maturity risk basically says if the bond is at longer time, okay, if it's a longer term bond, then there's more uncertainty in getting involved, then there's a higher risk, so the investors would require higher return. In contrast, if it's just short-term bonds, then it's less likely for the company to default on the debt payment, so the required return would be lower. The maturity risk is reflected in the time to maturity, okay, or the time length of the bond that endures. And also you have this contractual provision risk, and this is included in a debt agreement to a stock issue, and some of this reduced risk some of them may increase the risk. So this is just something for you to read. And for corporate bond, we have this long-term debt, and that basically is a way for a company to borrow money from investors, and definitely the company will pay interest back, and this interest is actually called a coupon interest. Okay, the coupon interest is paid annually at a fixed level, and usually for each year it could be divided into two equal payments. So it's really a semi-annual payment or a 6-month payment. And you will have the bond par value, or we also call it face value. It is usually $1,000, and that $1,000 will be paid at the maturity date. So whenever the bond expires, then the bond value will be redeemed. And you also have the bond maturity date. So that's the time between when the bond is due. So that's when the principal must be paid back. You also have certain legal aspects of the bond. So first of all, bond is a legal agreement between the borrower, which is the company, and the lender, which are the investors. And you also have a standard debt provisions. So these are specifications or regulations for the firms that regulate the firm, what they can do, what they cannot do. Okay, for example, if you have already borrowed $2 million from a bank, then this bank would prevent you or forbidden you to borrow another $2 million from a third bank. Okay, and this would also call a restrictive covenant, right? Or you can, so for example, if your company make $1 million each year, you cannot pay salaries at $1 million and leave nothing for the profit, right? So $1 million revenue minus $1 million salary is zero profit. And if you have zero profit, then you are unable to pay back interest. So that's something the banks would prevent you from doing that. Okay, so there's also cost to the issuer. Well, you know that when the bond is due, the company has to pay back the face value, and that face value could sometimes be higher than the money they get at the start. For example, if they sell one bond right now, they could get $900 for that bond. But that bond has a face value of $1,000. So which means 10 years after, when the bond is due, the company has to pay back $1,000 for the $900 they get today, right? So that's cost. You guys know that, right? They got $900 today and pay back $1,000 later. So there's a cost. And also during the 10-year holding period, the company has to pay coupon interest each year. Okay, the company has to pay coupon interest each year. That is also cost. And there are some other features of a bond. So you have a conversion feature, which means for convertible bonds, they could be converted to common stocks. Okay, so the bond can be changed to stocks. So what's the difference between bond and stocks? Well, one big difference is if you're a stockholder, you have voting rights. You can make a decision, or even partially, regardless of your holding share, still you are one of the decision makers of the firm. But for bondholders, you can only implement some constraint on the firm's operations, but you cannot vote or decide the firm's major strategies. There's another feature called call features. Okay, we can call it callback features. So that means when the bond is issued, the issuer can buy back the bond at a certain level of a price. So that price is not the face value anymore. It is a face value plus a call premium. So that's a call price, first of all, and a call price is a face value plus call premium. And we will do more practice later on. So the call premium is equal to, usually is equal to 1 year of a coupon interest for compensation to get the holders the bonds. So if the holders want to sell back the bond to the company, then they should get some perks, get some benefits. Otherwise, they wouldn't do it. So that's why the company has to pay the holders, some investors, some extra money. Okay. So you also have this stock purchase warrant, which is also something the bond could give you. This is just a way to sweeten the deal for a bond to be converted to stocks. Okay, and here are some other features you need to study. So these are current yield, yield to maturity, and yield to call. So here we have one example. Okay, we have one example of a corporate bond. This corporate bond has a face value of $1,000, and then the price is $940.07. Okay, which is this given quoted price times 1,000. This is basically a percentage, and also you have this company sees the price, which is $1,031.43. Okay, the bond could be priced at different level, and you will see for different companies, their bond could be sold at different prices, and what they have in common is that the face value of all these bonds are the same. It's all $1,000. Okay. However, for certain companies, they pay low coupon, like this one, only pay 3.15%. That means the interest payment each year is lower. And for this company, they pay like 5.2% coupon. That's higher. And also, they could be sold at different prices. And the yield to maturity is also different. And the yield to maturity basically is determined by the face value at the end, which is uniform at 1,000, and the price they sell today, which is whatever they have here in this column, and also the coupon rate. For specific calculation techniques, I have posted a video teaching you how to use Excel. Okay, that's one video. To do the bond valuation, and I have posted another video teach you how to use a financial calculator to get the yield to maturity. So make sure you watch those videos. And for the ratings of the bond, you have different ratings by Standard & Poor's, and there are also Fitch and Moody's. So in addition to Standard & Poor's, so these are the three rating companies on Wall Street. So the best of kind of bonds are called AAA. Usually is a treasury bond, and you have the prime quality, and they deserve long-term investment. That's why it's called investment grade. So it can go lower and lower from a AAA to AA to single A, and then to B level to C level, and to the D level, that means a junk bond. Okay, junk means trash. So basically, these companies who issue the bond would very likely to get bankrupt. Okay, so can we trust the bond raters? Well, I would say no, because during the 2008 financial crisis, a lot of the junk bond was rated AAA, right? So that's false rating. And a lot of bonds definitely went bankrupt during the crisis, and the investors just lost millions of dollars, billions of dollars. So you have to be careful about the raters, okay, like Standard & Poor, like Fitch, like Moody's.